time in the market beats timing the market. Or not. Everybody who invests in equity has heard such sayings over and over again. Start investing, don't worry, and everything will be fine. The market can only go up. Even Warren Buffett recommends buying the S&P 500 ETFs and nothing more. It is sufficient for the average investor who doesn't want to spend much time on research. But what about those who want to beat the market and dedicate their entire lives to investing? Interestingly, for those people, Warren Buffett has other advice. What Warren Buffett taught Bryan Lawrence. In the Investors Podcast episode 440, the investor Bryan Lawrence from Oak Cliff Capital describes a conversation with Warren Buffett from about 20 years ago. He says that in 2004, when he started his investment firm, he was lucky enough to be in a room with Warren Buffett and about 24 other aspiring stock pickers. They had just only one question to Warren Buffett. How can we become as successful as you are, just faster? What he found was astonishing. And here is the clip from the Investors Podcast episode number 440. Enjoy it.
He very nicely broke to us the bad news that stock picking was a long game. But he said, I do have a piece of good news for you. The average stock goes up and down by 80% in a year. And that's an enormous advantage if you actually take the time to understand the underlying business, because stock price is not reflecting the underlying value if it's going up and down by 80%. I said to myself, 80% in a year, he's got to be out of his mind. He's Warren Buffett, but he's lost his mind. I went back to New York and I did the calculations he was suggesting, which was to compare 52-week high to 52-week low for every stock in the stock market, and compare the percentage difference between those two things. And when I did the calculations, maybe not surprisingly, because he is the sage of Omaha, he was right. You can use Bloomberg and a computer to crunch these numbers for the thousands of companies. It's about 4,000 companies in the US stock market going back 20 years. And if you do it, we do it about once a year. The answer is as astonishing now as it was in 2004 when I started. During a calm year like 2019, the average US stock price goes up and down by 50%, 50%. And in a crisis year, like the dot-com crash we had in 2000, or the 08-09 financial crisis, or the pandemic we just had in 2020, by up to 200%. Buffett, by saying 80%, was basically averaging a calm and a crisis year. And that 50% in a calm year is also a median. In a median year where it's 50%, you'll have many stocks that are bouncing up and down by 80%. There's no way that the intrinsic value of the average business is going up and down by so much each year. And this is a big advantage for a stock picker who's done the work. So what we spend all our time doing at Oak Cliff is working to understand great businesses. We own 11 right now. There's several dozen others we'd like to own. And we wait for their volatile share prices to give us an opportunity to buy at low prices.
So how will I apply this recommendation? Doing your research is at the core of every investment strategy. Only those willing to read daily and talk to successful investors can consider using such tactics like Warren Buffett and Bryan Lawrence described. Among those who do, having cash on the side is always helpful. Dry powder wins the game. Patience is a character trait investors need to develop. Never buy at the highest point when everybody recommends a stock, and on the opposite, never sell a stock at the low point. Put a new stock on a watch list or social trading profile. Just keep in mind the stock fluctuates by 80% every year anyways. Or when you want to dip a toe into the waters of a new stock, buy a very small first position and keep dry powder on the side and watch the development of the stock, whether it goes up or it goes down. And then simply wait. Usually negative press, and a lot of negative press, signals the low point, and then you have to go against your herd instinct and buy the stock. When the business is, and this is the point, is durable and has excellent management, the low point is the time to put money to work. On the other side, when everybody starts recommending the stock, maybe it is time to trim the position a little and wait until the market mood changes again. Happy investing.